Hey there, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a nice, warm, and sunny Redmond, Washington. Happy Fed Day. It's the end of January. We have now wrapped up the first month of 2024. It's been an interesting one, to be sure, from a technical perspective. A lot of volatility, a lot of uncertainty, really ending the month of January with a bit of mean reversion. Some of those growth leadership names reporting earnings, stocks like Alphabet, Microsoft, AMD, others really moving a lot because of earnings. We have even more Apple and others reporting through the course of this week. Fed meeting, a lot of movement as a result, and really the afternoon, sort of after that Powell press conference around 2:30 p.m. Eastern, very much a risk-off move. The Nasdaq finishing lower by over 2%. Now, what does this all mean? We're going to talk with our guest today, Tony Dwyer of Canaccord Genuity. Brilliant discussion, I hope, about relating what we heard today with some of the big picture themes that we've been talking about. Some of this rotation away from growth leadership, maybe into other areas of the market, some of the value-oriented sectors. And how concerned should we be about the drawdown that we experienced just here on January 31st? With that as a setup, let's get to the charts and focus on our market recap. Before we bring up the charts, I do want to answer a poll question because we asked you recently, do you think the S&P 500 will retest its October 2022 low? That's S&P 3500 through the course of 2024. Now, I will tell you, it is very hard to put on a crystal ball and guess where the market may go through the course of the next now 11 months. However, I think it's really helpful to think about those extreme movements and what that might actually look and feel like to you and to your portfolio. So about 2/3 of you saying, not seeing it, not seeing the S&P retest 3,500. That is a long way down, let's be clear. But 38% of you, about 4 out of 10, saying you think we will retest the October 22 low. Now, whichever way you would answer that poll question, I would encourage you to think about the opposite, right? If you're all bulled up here and you think that this market's just going to continue higher, think about what that doomsday scenario might look like. Think about what stops you may need to have in place, what alerts you might want to send, what charts will change, and what signals may come out to help you validate that that's actually playing out. I always look for a line in the sand, kind of a red flag alert of some sort. If you're really bearish here and you think we're obviously going to retest the lows, what would compel you to remain invested, to remain long in this environment that you feel is so uncertain? We hope that stock charts can be part of that way that you answer those questions and hopefully plan and analyze the markets through the course of 2024. Let's talk about what the markets did today. The S&P finishing lower, end of the day about 1.6% down. We're just below 48.50 to 48.46. The Nasdaq Composite pushing even further down 2.2%, and the Dow down as well. So pretty much everything down, although that's not true. There were some things that were up just fine. We'll highlight some of those charts as well, time permitting. But overall, very much a risk-off move, and it really accelerated after the Powell press conference around 2:30. Mid-caps, small caps all down as well, and the S&P 600 small cap index was down 2.6%. That's your worst performer on our front page of major equity indexes. The VIX pushing up over 14. It's up a full point. It was around 1430 yesterday, 1340 or so. We're now up above 14. Now again, still relatively low. The VIX has a long way to go before it hits any sort of danger zone. I've usually thought of VIX 20 as sort of that general level at which a low volatility environment becomes something different. I'm drawn back to my conversation with Tim Hayes of Ned Davis Research. I think that was just before the holidays where we were talking about the VIX. And he was actually talking about VIX like 2850, if I remember, somewhere around there was the level that they paid attention to in their analysis of deep market history. But whoever you ask, a level of 14 is still pretty low. This is a low volatility. Even with the sell-off of a bit today, still low volatility environment. But keep an eye on that VIX chart. That's why we have it front and center on our market dashboard, just to make sure you know where that level is. Looking at the bond markets, interest rates overall coming lower. So the entire yield curve sort of shifted lower, but the long end of the curve pulling down much more than the short end. The 10-year yield is below 4%, around 397. 5-year points around 388, and the long bond yield around 4.22%, we'll call it. All those 5, 10, and 30-year points all coming down. This is as the bond market rallied after the press conference. So the TLT, which is a long bond ETF that we track, was up about 1%. The dollar index, not too much of a change, up about 0.25% from Tuesday's close. Looking at the commodity space, mostly in the red. The natural gas ETF UNG was up slightly, but everything else is sort of on the downside. Energy stocks got hit as crude oil prices went lower. We've talked about that mean reversion trade where crude oil prices have been so weak for so long, but really in the last month starting to show a reversal from downtrend to consolidation to a bit more of an uptrend, pulling back a little bit today, just like stocks in general came off. The USO was down 2.6%. Gold actually ended up in the red and just narrowly earlier in the afternoon. It was just above that zero line. Through the course of the day, sort of sold off. And so the GLD essentially ending the day flat from Tuesday's close. Cryptocurrencies were doing just fine until the equity market opened. And then you could see in the equity afternoon of the equity session, you can see Bitcoin rolled over pretty good. Currently down about 0.9% from yesterday, around 42,550. Ether prices around 2284, we'll call it, down about 2.5%. And most of the top 10 cryptocurrencies that we're tracking down. Bitcoin, of course, bouncing off of that 39,000, 40,000 level recently, still holding up quite well relative to that support, but pulling off a little bit with other risk assets. Looking at the 11 S&P sectors, by the end of the day, all 11 in the red from just a little bit to quite a bit. So let's look at some of the top, the top performers on a relative basis, even though they were all in the red. Healthcare down slightly, utilities, real estate as well. So your top sectors are pretty defensive, right? If you ask me, name the 4 defensive sectors, I would probably not necessarily in this order, but I'd say utilities, real estate, consumer staples, healthcare is kind of in the middle because there actually is some offensive kind of stuff in healthcare, but still pretty defensive of a sector. So those are your best performing on a relative basis. The sectors that really got hurt were the growthy sectors, right? The FANG sectors, communication services, technology. Now we have a lot of earnings we're processing in those sectors this week. We'll highlight some of those charts like Alphabet, Microsoft, really moving quite a lot today. But the XLC was down 2.5%. The technology sector down 2.1%. Energy and consumer discretionary both down about 1.8%. It's interesting. One of the 3 and 3 charts we had on the show yesterday, if you missed it, go back and watch it because one of them was looking at the performance of financials versus technology from the October 23 low to just yesterday. And what you'll note is as of today, financials have now outperformed technology from the end of October, the next 3 months to now the end of January. Financials over tech, and not something I would have guessed. Even in the last couple of weeks, I probably would have said that your data is questionable if you're telling me that's how things have played out. But look at the charts; they will tell you that is the case. Let's go to the daily chart of the S&P 500 and check in on what happened. Here's today's sort of drop, really erasing the gains that we've had over the last week and a half or so. If you think about what's happened here in recent market history since the new year started after December was sort of stalling out a little bit between 4,700 and 4,800. The first half of January remained in that range. That's that purple shaded area that you see here. In mid-January, we broke out of that range and accelerated to finally get above 4,900 for the first time. Just with today's drop, we've erased most of those gains. So take that big day out of the base, and we're kind of right back to that same close. And that's how quickly in this sort of environment you can unwind some of the gains that you've had. A slow and steady sort of low volatility rise feels really, really good, but that first day when you drop, you realize how quickly those previous gains can be erased. Now, let's remind ourselves that this is not an end-of-the-world kind of move. As a matter of fact, the S&P is still in fine shape. We're still making higher highs, and we're a day or two off of a new all-time high. So things are not that bad, even though we dropped about 2%, 1.5%. Still pretty good. And what you have to remember is, as long as we make a higher low, the long-term structure of the S&P, I would argue, is still pretty stable. So now would be a really good time, if you've not done so already, to think about some of those downside objectives. Let's say this is just the beginning. Let's say the jobs data, the other economic data through the remainder of this week, suggests that the economy is shifting much more quickly than the Fed is anticipating. As a result, risk assets really accelerate to the downside. What levels may come into play? The S&P 500's 50-day moving average is just above 4,700, right around 4,710 today. It is, of course, sloping higher, but you'll notice that it's right in that purple shaded area. It's kind of that 47 to 4,800, a really logical place to expect any sort of pullback. And what's interesting about that is if we find our footing kind of in this range that I'm highlighting around 47.20, 47.50, that would actually make a higher low from the previous swing low there in early January and could set us up for the next leg higher. So even though we have this sudden drop, as long as we hold support, as long as we make a higher low, by definition, that trend is higher. We just said goodbye to Ralph Acampora yesterday. Had a lot of fun interviewing him here at the Stock Charts office. He shared a fantastic chart, donated it to Stock Charts, which are now featuring in our headquarters. Would love to share some insights from that chart over time for sure. But in talking with Ralph last night, I was reminded once again about his comments. In a big uptrend, you wait for pullbacks to see if we can keep making higher lows. And as long as those lows keep getting higher, the trend is still probably okay. So pulling back is natural. Let's look for some potential support there. If we would break the 50-day, that's where I think you want to look for some additional levels. What's interesting is, based on yesterday's high, which was now the high for the cycle, a 38.2% retracement would get us to around 46.15, which is almost perfectly lining up with the July 2023 high. So that makes a ton of sense to me as a potential support level, 4,600. We undercut that, and you're getting down to the 200-day moving average, the 61.8% level, right around 44.30, 44.50. So some clear levels of delineation there below current levels if the market would continue to sell off through the course of this week. And earnings certainly could be a big part of that. It's interesting when we're talking about this sell-off today, or today's pullback, I guess, and the NASDAQ composite down 2+%, the NASDAQ 100, the QQQ down 2%. I mean, just keep in mind, when you look at a 2-year chart of the Qs, this almost is like a blip, right? I mean, it's hardly even recognizable on the chart. And that's what you have to remember. We've had such incredible gains on a lot of these leading names that a pullback of 2% isn't much relative to the trends that we're talking about. I mean, look at the move that we had from the end of 2022 to the end of 2023, and just in early days of 2024, how we continued to push higher. This is just a brief drawdown, and still within the context of an uptrend. I think the market would have to deteriorate a lot more for us to think of it as something more negative than what we've seen so far. With that in mind, let's look at a couple other charts here. I do want to highlight the VIX, by the way. Just look quickly at that chart. I mentioned before, of course, volatility, always an important one. And I love to ask my guests, what sort of red flag chart they would be looking at. For me, the VIX might be one of the better ones to pay attention to, because as long as the VIX remains in the low teens, just things aren't getting that bad. And the way you would define things aren't getting that bad is, are you seeing signs of fear, signs of uncertainty, signs of negativity from investors? And one of the best ways to measure that is with the VIX. Now, this is looking, if you're not familiar, looking at the S&P index options market and looking at options and how they're trading, and inferring or implying the volatility on the S&P based on how those options are trading. So the VIX in the low teens basically means it's a low volatility environment. There's not a lot of craziness. This, of course, is going to elevate on a day like today, but still relatively low, right? I mean, we're still at the lowest levels we've been for years, right? You have to go back to kind of the mid-2000 teens, maybe back to like 2017 to a VIX sort of remaining in this low sort of range. So we're still pretty safe here. The VIX has to spike quite a bit more to indicate any sort of real negativity. And I would say the two things I would be looking at: number one, do we break out of here above 14.15, which we're really close to it? We break above 15, and all of a sudden this looks a lot like August of last year, September of last year. These were some drawdown periods, not too small. I mean, there were actually some meaningful pullbacks of 2 to 4 weeks. So recognizing that a spike in the VIX could just mean a short-term move, but you have to get a lot higher, up in the 20s, maybe even in the 30s, to indicate a broader decline, right? So I think we're still pretty safe using that as a general framework. I do want to highlight breadth. We're going to talk with today's guest, Tony Dwyer, about different breadth conditions. I think there are two things you take away from when the percent of stocks above their 50-day moving average got all the way up to 90% at the end of last year. Two things that I would take away from that. Number one, long term, it actually tends to be quite constructive, right? So many stocks don't tend to be that bullish unless we're in a broader kind of secular rise in stock prices. So I think overall, it's probably a good thing for the long term. But in the short term, it usually lines up with some short-term market weakness, what we might call a tactical pullback. And if you look to the left, when we've gotten the indicator up into this range, we've often had some decent pullbacks to pay attention to. Not the end of the world, and the uptrend can still be in play, like we saw in November of 2022. But it was a bit of a drawdown, right? A bit of a pullback, which ended up presenting investors with a pretty good entry opportunity. So that's kind of how I think of it. It sort of lines up with the short-term pullback, long-term uptrend kind of general thesis that we've been trying to feature on the show. With our time remaining, let's look at some sectors and probably more some individual names. When I think about this sort of tactical condition, the drop we saw in assets today, in risk assets, not surprising. Hopefully you've been following our work and following what we've been talking about on the final bar. These overheated breadth conditions at the end of last year really told us that going into January, and given the seasonal weakness, highly unlikely that we get through the first quarter without some sort of pullback that could be meatier than a lot of people expect. And so a day like today makes a lot of sense given that as a backdrop. But when we're talking about sectors like financials, which have emerged as a new area of strength, industrials, we're finding things like airlines bouncing off of lows, and building materials, heavy construction names having a pretty decent time. I'm noting that the XLI, the industrial sector ETF, had this high around $114 in late December. We're kind of right there again. So it wouldn't be unrealistic to have a bit of a pullback here, particularly given how much the momentum has dried up. The RSI at the December high was around 82. The RSI on this most recent retest of that same level is down around 60. So the momentum is much weaker than it was a month ago as we were retesting these same levels. That's that bearish momentum divergence we've highlighted on a number of charts that we've been talking about. So I think a pullback on a day like today is just part of a broader pullback scenario. I think in the end, it probably ends up being a really good opportunity to re-enter some names that might have pulled back to more reasonable levels. With that in mind, let's talk about Alphabet. Alphabet gapping lower today. Of course, earnings yesterday for Alphabet, Microsoft, AMD. The charts, generally speaking, not great. So let's look at the chart of Alphabet here. We've highlighted this breakout level, or kind of this resistance level, right around 142. And that was the high from October and also the high from December. We broke out above that level. And up until, yesterday, this chart's looking pretty good, right? Higher highs and higher lows. Today, of course, we're shedding about 7.5% of the value. We're actually pulling right back to this little hammer candle here. And if you can't quite see that, let me go into this chart. Here's that hammer candle. On this, it actually looks more like a doji candle or something like that. Boy, go deep into your candlestick now. They actually call it dragonfly doji if you really want to know. But that's where the open and close are very, very close. You have a minimal upper shadow and a long lower shadow, and basically means it's a short-term reversal sign. So you have a pullback, you have that candle. It tells you we're probably bouncing higher. So we've actually traded right back down to that low. We've traded back down to the 50-day moving average. So what's interesting about names like Alphabet that have had their run, when we drop, when we pull back, which we may be experiencing right now, you look to the left, you look for opportunities for support. Something like Alphabet kind of right there. As long as it holds this general level, not too bad, right? And still making higher highs, higher lows. We break below 139, 138. We failed to hold the recent swing low. We failed to hold the 50-day moving average. We'll probably have a different conversation through the course of this week here on the final bar. That's our market recap for today. Again, a lot to unpack. We're going to talk with today's guest, Tony Dwyer, a little bit more about the Fed meeting and what we learned. So I'll save some of the thoughts for that discussion. But I do want to let you know, before we bring on Tony, one thing we'd love to hear from you. We appreciate so much your questions about stock charts, about the financial markets, about technical indicators, and just all the different questions you are trying to answer. We really are here to help you along your way. We hope that stock charts can be a big part of your analytical process. Anything we do to make that easier for you, we're up for it. Our email is thefinalbar@stockcharts.com. We're on X @FinalBarSCTV, and on our YouTube channel, of course, just drop a comment below the video that you're watching. We'd love to hear from you and hope to answer one of your questions in our next mailbag episode. All right, I want to bring on today's guest, Tony Dwyer. Tony's the Chief Market Strategist at Canaccord Genuity, coming to us from New York. Tony, Happy New Year. Happy Fed Day. How are you?
It's great to see you, David. Always good to be on.
Good to see you as well. We have a lot to talk about. Obviously, a lot of things happening this week. Fed meeting, jobs data, a couple of companies reporting earnings, so a lot to kind of think about. When you take a step back, your first table is really just, I think, sort of addressing the conditions now versus what's often happened in this sort of environment with breadth. Talk us through what you're seeing here, what it tells you about the conditions going forward.
Well, David, you and I have been doing this a long time, so you're going to recognize this name. Our old friend Marty Zweig, the late great Marty Zweig, who
Yeah.
used to be the guy on Wall Street Week with Louis Rukeyser. He was one of the elves. He has a statement that he really popularized, and it was, "Don't fight the Fed and don't fight the tape."
Mm.
Right? The dovish pivot that took place in December by the Fed changed the tone of the Fed to easing, even though it doesn't feel like it today. However, it also is don't fight the tape. And that's what this table really speaks to. There's a popular indicator that folks like us use. It's the percentage of S&P 500 components trading above their 50-day moving average.
Sure.
Whenever that gets above 90%, historically, it's been a really good buy signal. Bull market signal, right? So we did it in a proprietary way at Canaccord. We looked at that on a 10-day moving average. So it's a long duration move above, with more than 90% above the 50-day. So not only is it a good, thrust above intermediate term uptrend, it stayed there. And when you go back to 1990, what you see is the instances where that took place, and there's some volatility. Like we're seeing it now. There's some volatility. But what do you want to do with that volatility? This table answers that question. You want to buy it because the market in each instance was higher 9 and 12 months later by a median 11 and 13%.
Right. So sort of we're in that choppy period right around those signals, but the long-term implications are actually quite strong when you have this many stocks going up. I think is the clear takeaway there, which I can't disagree with, Tony. One of the big, I guess, criticisms or challenges a lot of people have had with this market recently has been the dominance of the largest names, lack of participation from the smallest names. Help us look forward through the course of the coming months. Where do you see small caps headed? What does that mean relative to the rest of the market?
So the Fed is eventually cutting rates, Dave, and you've had a high concentration in the market. I looked yesterday, and I believe the top 10 stocks the top 10 stocks in the S&P represent 80% of the gain this year. Now that typically that's high, but it's supposed to be. It's a market cap weighted index, but it does show you the concentration is outsized. In addition, as you know, Dave, the top 10 stocks as a percent of the S&P 500 is about 33%, just over 33%. That's way higher than .com, and it's even higher than it was the case in the early 1970s with the Nifty 50s. So if you think that the market, even the S&P market cap index, as the prior table showed you, is going to be higher over the intermediate to long-term 9 to 12 months, well, where do you have the greatest opportunity? And in our view, that is with those areas in the market that have lagged relative to that S&P, the S&P equal weighted index and the Russell 2000. So there was a broadening. The broadening was big enough to give you that breadth thrust. Now you've given back some of those relative gains, and it might be a good time to, when you're thinking about the next couple of years, to be longer the broader market.
It's interesting, and when we're getting away from kind of the large cap leadership into small cap and smaller names within the S&P, I think you're naturally going outside the growth sectors a little more into value sectors, things like industrials, probably financials and others. Do you think that's part of this story as well as a rotation to some of the value-oriented sectors that have been lagging?
Well, it has to be by definition, because if the Fed is lowering rates and they're going to lower rates, it's likely because of weaker economic activity. Otherwise, they already would have. I mean, over the last 6 months, your core inflation rate's already back to their target. So they're not changing rates because they're still unclear on economic output. You really need economic weakness. And what they told us today in between the lines is you're going to need economic weakness. They even mentioned the labor market, that may make them cut rates sooner. So we know they're going to cut rates. They changed the tone. That was the dovish pivot. That was priced in. Now we got to wait for what that means in terms of economic output. And I think that's where the Fed is going to be more aggressive, is if the employment reports start getting, over the next 2 days, you got a couple of key data points: the ISM manufacturing, where there's been a recession, and all the payroll data coming out on Friday.
Right. Yeah, that's coming up through the remainder of this week. This week, there's no end to, I think, the number of data points we're getting just in this week here. So just to reiterate, it sounds like what you're saying, and I think that's what we heard from Powell today, was really, making sure that the economy is slowing down to the levels that they were expecting. And we're not quite seeing enough of that yet. So how important is it to really follow that economic data here in the coming weeks, coming months? Is that the most important set of information we should be following?
He told us it's going to be the most important determining factor. It's bad data, though. I don't
Yeah.
think most people realize that, the data that's coming in is incomplete data.
Yeah.
And I don't want to go too into the weeds, but the way they collect the data is flawed. And that flaw is creating enormous revisions to the initial data points. And that's a really big deal, Dave. So like if, for example, if you reach out to 100 companies to get what their payrolls are doing, and only 30% of them give you a response, you still got to publish that number. And that's
Right.
what's happening. That's why we're seeing these huge revision in the payroll data. Pre-pandemic, it's called the initiation survey rate. Pre-pandemic, 70% of companies that were polled got the data back in time to put it into the initial report. Now it's 40% median and under 40% recently. So your data collection is a problem, but they're data dependent. So they're
Right.
moving policy around on a guess, and I think that's probably why they're hesitant to move too quickly until they see those revisions.
Let's don't let incomplete data get in the way of our conclusions, right? I guess is what they're saying there. Can you talk to us a little bit about what happens when the Fed starts to lower rates? What does that path of rate cuts look like in your mind?
Well, unfortunately, a couple of politicians just politicized the rate move because Elizabeth Warren and Sherrod Brown, Senator Brown, sent letters into Jerome Powell to cut rates, which, he was going to do it anyway. So that just politicized it for some unknown reason. But with that, here's the thing that I find interesting. The core inflation rates coming down as quickly as it went up. They raised rates at 75 basis points a clip for 4 meetings in a row, not to mention the other 50 basis point hikes. So the idea that they're going to do 25 in an election year, they're going to start cutting rates right before the election. That's a pretty tough move. So the really counterintuitive move is they wait a little bit longer, so maybe not the March meeting. I still haven't. Listen, if we get weaker data, watch how fast the market prices in a rate cut in March. So, in our view, if you are going to cut rates in an election year, you're probably going to do more than you think, but not by the number of rate cuts, but maybe by the size if the data does come out to be pretty weak.
A lot of discussion has been made, certainly sort of like the scary strategy pieces, talking about a recession and how much of a deterioration in economic conditions that would imply. How much of that plays into your thinking? Is, should we be worried at this point about whether the economy falls into a recession? Is that just sort of normally priced into the data that we're looking at? How important is that R word in your head?
It's a pretty important. I'm still in the camp. It's been tough to be in that camp. The long and variable lag has been long for the whole economy, but manufacturing's been in a recession for almost 2 years.
Right.
The ISM report's been under 50. Even with the easier financial conditions since the Fed's December dovish pivot, all 6 regional Fed and ISM regional surveys for manufacturing are worse than they were the month before. That is kind of counterintuitive to easier financial conditions. So the point is, maybe the rest of the economy or the service economy weakens a little bit more. That brings it into the manufacturing side. But Dave, the Russell 2000, I think, is 20% below below its all-time high. It had been down 33% from peak. My guess is a lot of stocks are kind of pricing in the fact that you could have a mild recession. And that's why I think the opportunity is going to be in the broader market or the Russell 2000 versus trying to figure out the NASDAQ and S&P, mega cap indices.
Yeah.
I mean, today you got one of the biggest names gave back all the gains since last September.
It happened
On a
very
tick.
quickly, didn't it?
In a day. So, you look at some industrial companies that have done that. Risk happens fast. And they're in, again, going back to Marty Zweig, when you don't want to fight the Fed and you don't want to fight the tape, those are where the opportunities present themselves.
Speaking of not fighting the tape, what sort of, red flag would you see that would tell you, okay, this is way more of a risk-off environment than we expected? Is it something like the S&P, the NASDAQ breaking a key level? Is it the leadership names struggling? Is it the VIX? Is it volatility spiking, indicating an additional fear? Like, what would you look for as a red flag for this sort of market here?
I'm looking for all of those, and it's happening. So if you look at the weekly stochastic for the S&P 500 equal weighted, for the Russell 2000, for the VIX, and for the 10-year bond yield, they're all showing the opposite of what they showed last October,
Yeah.
right? They're overbought, they're hooking lower, and they're working off the overbought condition. To me, it's very hard to pick a price anymore, Dave. As a technical guy, I don't know that you'll appreciate this, but it's the NYSE doesn't have any specialists. The market makers, there aren't any. It's algos, it's quants, and it's CTAs. So trying to pick where there's more demand and supply, I'm not smart enough to write the computer program. So what I'm looking for is not the price, but maybe the condition. I'll look for something at the low end of neutral for the weekly stochastics or MACDs or RSIs, or you pick your favorite technical indicator.
Yeah.
I think you work off that overbought and get into the neutral zone where the math starts to work in your advantage, and you can start adding exposure into that neutral zone.
Super helpful, Tony. We'll have to leave it there. Listen, thanks for joining us on a Fed Day, helping us to kind of make sense of what a number of us are certainly following. Be well, stay safe, fly safe, and we'll talk to you again soon, all right?
Have a great day, buddy. Great to be with you.
That's Tony Dwyer. Tony's the Chief Market Strategist at Canaccord Genuity. I mean, what a pleasure to talk to someone like Tony after the Fed, sort of seeing the headlines, watching the press conference with Chairman Powell, and being able to ask Tony some of these questions about, what's happening. I think his comments about the trajectory of Fed rate cuts in 2024 really, really helpful. Thinking about sort of what we heard today and what the evidence of the market is telling us, the importance of some of this jobs data coming out through the remainder of this week. That was one thing I certainly jotted down during the Powell press conference, was really focus on the economic data through the remainder of this week. They mentioned they're data dependent. As flawed as that data might be, that's the data they're looking at. That's what I want to look at as well. Special thanks there to Tony Dwyer of Canaccord Genuity. Folks, we got to wrap the show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. We're looking at the S&P 500 here. In our market recap, we talked about the pullback day, the S&P down 1.5%, NASDAQ composite down even more, the growthy stuff really struggling. Not surprising to have some sort of pullback, and I would say the main reason is twofold. Number one, we've been overbought, and as we've mentioned in recent episodes, as we keep going higher, as we remain overbought, overbought means up a lot. On the surface, that's actually a very constructive sign for a chart, but it also tells you we're probably due for a bit of a tactical pullback. So a day like today, after the Fed press conference, makes a good sense from a technical perspective. I would, as I mentioned in the market recap, be thinking about some downside targets. I can't guarantee what's going to happen tomorrow or next week or anything like that, but I would tell you I'd be looking for a pattern of higher highs and higher lows to continue, which means trying to think about where some of those higher lows may come into play, what levels of support you want to pay attention to. And by the way, this is a really optimal time to be using the alerts functionality on stock charts. Think of something like the S&P, the Qs, small caps, individual sectors or names. Make sure you set alerts for key levels that you're paying attention to. Stock charts will email you, text you, pop up a banner right on the website and let you know when things are happening. In pullback phases, that's when that alert functionality can be literally a portfolio saver. Chart number 2 is Home Depot. We've highlighted Home Depot. It's actually one of my go-to charts when I'm just bringing up a stock to analyze charts and trends, because it's pretty liquid, has good history, and a lot of great patterns to pay attention to. The chart of Home Depot for me represents a lot of charts that are out there. This is the condition that we're in here at the end of January 2024. Many stocks have made new highs from November to December to January. Home Depot, the case as well. Many of these stocks became very overbought in mid-December going into the holiday season as they made a new swing high. And many of them either not overbought or certainly showing a divergence here in January. So making a new price high, but on weaker momentum. Now, the proliferation of those bearish divergences is certainly something that is concerning for me, because a strong bull phase sees higher prices on stronger momentum. An exhaustion point in a bull market usually coincides with higher prices on weaker momentum. Now, what's interesting about a chart like Home Depot, we could draw this trend lines a number of different ways, right? There's no, necessarily, specific way that you need to draw trend lines. I think they're really more subjective in a lot of ways, but I'm connecting the October low to the November low. That lines up pretty well with the lows we've experienced in the last couple weeks. And today's low lines up almost perfectly with this trend line that I drew. So we're not too far away from this trend line being broken. And all that tells me is the uptrend as defined by this trend line is now different. We're shifting from a stretch of market strength to more of at least a bit of a corrective phase. And I'm immediately looking to the left to find swing lows, to find the 50-day moving average. Home Depot below 339, a very different chart where all of a sudden we're failing to hold support. So make sure you identify those key levels on charts that you're interested in. Final chart of the 3 and 3, Stryker. Stryker is one of the healthcare names. It's in the medical equipment space, gapped up about 6%, one of the earnings names this week. We highlighted Stryker, I want to say, in our January, the top 10 charts to watch in January. I'm pretty sure we talked about Stryker, and if not, I probably meant to. Stryker is a really just classic basing pattern, right? This resistance through much of 2023. You can see the pullbacks that just kept coming up and retesting that resistance. We finally broke out in early January and now gapping higher, but that's just the latest move within this nice consistent uptrend over the last 3 months. The reason why I want to highlight Stryker is because of that gap that is continuing this uptrend, but also because Grayson Rose and I will be sharing our top 10 charts to watch for February at the end of this week. So keep your eyes peeled for that special edition of this show. That's a wrap for today's show, folks. Thanks so much for joining us every weekday after the close for the final bar. A special thank you to Tony Dwyer of Canaccord Genuity joining us from New York. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.